Grab your favorite mug and fill it up with your favorite blend because we're getting ready to sit down and talk about Southwest Florida real estate. Cottrell Title and Escrow presents The Closing Experience, real estate talk over a cup of coffee. What are my closing fees going to be? Should I rent or should I finally purchase? Why do I have to send all of these documents to get a mortgage? The real estate process doesn't have to be frustrating. Let our experts at Cottrell Title and Escrow help make buying or selling real estate a dream. Here to answer all of your questions, our host, managing partner of Cottrell Title and Escrow, James Schlimmer.
Good morning, Southwest Florida, and welcome back to The Closing Experience, real estate talk over a cup of coffee. I'm your host, James Schlimmer with Cottrell Title and Escrow, and it is a beautiful morning in Southwest Florida. I start every show saying that, but it really is. I never get tired of the sunrises and the pink skies. This is why everybody moves here to Southwest Florida, because it's just so gorgeous. Some of our counterparts up north, they're freezing, and we get to relish in the fact that we live in this paradise. As we get ready to get started this morning, we've got some great things on the show today. Number one, I'm going to be sitting down with Justin Cottrell, who is a real estate attorney and ends up my partner here at Cottrell Title and Escrow, to talk about real estate law and get some of your questions answered. We're also going to sit down later on in the show with BJ Cottrell of Cottrell Tax and Accounting and get some tax real estate questions answered. And to begin with, I wanted to kind of go into the question that I've gotten more often than not are, what are closing costs in a real estate transaction? And I'm getting questions on, hey, can you explain what these fees are and how do tax prorations work? And I want to be able to kind of go over that early in the show. As I sit down here, obviously the show is The Closing Experience, real estate talk over a cup of coffee. I am sitting down here with a regular Keurig blend from the office. Nothing special. Got to be honest with you. I wish I was having a much better cup of coffee, but it will suffice. I hope you guys are enjoying your fine coffee as you are getting ready for your weekend. And with that, let's get right into it. It's Saturday. It's the weekend. We're still in height of real estate season here in Southwest Florida. And typically on the weekends are when buyers are getting taken around by their agents. They're viewing properties. Sellers are waiting for that offer. And once you do have a fully executed offer, meaning the buyer and the seller have agreed to the terms and have signed the contract, you're under contract. Congratulations. I was just teaching high school seniors at Gulf Coast High School in Naples a couple weeks ago, and I go over this process. And what we don't have an opportunity to do, because obviously they're students, is, hey, what are closing costs and how can you prepare for them and how can you explain them? And I want to be able to dive right into that topic here first thing in the morning and allow you guys, one, if you're not taking notes, no problem. You're just listening. But you can always go to The Closing Experience at fltitlegroup.com. Send me an email. You can find us on Facebook at The Closing Experience. You can find us all over. If you want to download our podcast, this show, I'll make sure is up there for an explanation of the closing costs. Go to iTunes, do a search for The Closing Experience. You'll find us there. We're on Spotify. We're everywhere. You can also call us at 239-431-8200. Or head over to fltitlegroup.com where you can download the podcast as well. But just keep listening in the background here because you're probably going to get some of your questions answered on what are these closing costs in a real estate transaction and why do I have to pay them? Number one, you get under contract and there's a purchase price, okay? And that purchase price, let's just say, is $500,000. What are the fees associated with this real estate transaction? And what happens is that contract is typically sent or it's created with your real estate agent, by your real estate agent, and all the details on who pays for what are inside that contract every time. So I can't begin to tell you how many times people come into my office and they've already signed. And I'm sure we'll talk about this with Justin Cottrell later on in the show, but they've already signed and they'll look at us, hand over the deposit and be like, well, everything's good, right? Or they want to argue who pays for what. And it doesn't work that way. All the details on who is paying for what specific closing fee are all laid out in the contract. And if you have questions about that, call us before you sign. 239-431-8200. Email The Closing Experience at fltitlegroup.com. You could even say, hey, I think I'm getting ready to buy. What should I expect for closing costs? Or if I'm getting ready to sell, what should I expect for closing costs? And you'll hear me later in the show talk about, you can head over to fltitlegroup.com, click on the closing cost tab, register. It's free. And you can actually get in there and be able to play around and get real numbers so you understand that. But when those numbers show up, a lot of times folks are thinking, what are these fees? Why do I have to pay them? Let's talk in the beginning here about prorations and how they work. We have a lot of folks that come to Southwest Florida from all other parts of the world, but specifically up north in the United States, whether you're coming from New York, Massachusetts, Minnesota, Ohio. And a lot of times you guys are used to paying your real estate taxes in advance. And down here in Florida, you're paying them in the arrears, or you pay them behind. Okay, is a good way to think of it. So what happens is, number one, we'll always spend time in a real estate transaction explaining how the taxes work. And if you want to understand that, here's the explanation. If you're to close a real estate transaction, typically anybody who owns real estate in Florida, and let's use Collier and Lee County, for instance, right around November, you're going to be able to pay your tax bill. And what most folks are thinking is, hey, when I'm paying in November or December, I'm paying for the next year. But you're not. You're actually paying for the current year. And what happens is when you look at your tax bill, there's actually a breakdown of what they call ad valorem taxes and non-ad valorem taxes. And the ad valorem taxes are what's based off your millage rate for where you're located, and that's where you get into the cost for the libraries and the police and the fire and all the above. Your millage rate multiplied by the taxable assessed value, you get your ad valorem tax for your home. And the ad valorem is always paid in the arrears behind, okay? And so if you were to close or sell a property, or you were to purchase, and we are in the middle of the year, let's just say July, that seller has to give a credit to the buyer because the buyer is going to get the tax bill and pay the taxes for that current year in November. Okay, now they could pay them in November, December, January, February. It's due, you get into March. But that seller has to make the buyer whole because the buyer is going to pay the whole year, but they didn't own the property the whole year. So that's why the seller always gives a credit to the buyer for ad valorem taxes. Now, if you look at your tax bill, there's usually a section in there what they call non-ad valorem. And the non-ad valorem, which is, ask me why the state of Florida or the counties do this, I don't understand, but it's difficult to explain at times. But the non-ad valorem part of the tax bill, or the portion, is paid in advance. So if typically you'll see under here a solid waste assessment, typically you could have your CDD assessments on there, but whatever that amount is, that is paid in advance, and that is paid on a October through September. So what happens there is when the taxes are paid for the current year, that property owner is going down and paying just a lump sum. A portion of it is paid in the arrears, and another portion is paid in advance. So what you'll see is, hey, the seller has to give a rather significant credit if the property closes mid-year to the buyer for the ad valorem portion, but the buyer is giving a small credit to the seller for the advanced non-ad valorem taxes that were paid on the previous year's tax bill. If that confuses you, and if you have questions, feel free to reach out to The Closing Experience at fltitlegroup.com or dial 239-431-8200. I would be happy to explain it in detail, but that's a very quick explanation on what you're looking at there. As we move on down the list here into the closing cost world, one of the other closing costs you have are association prorations, right? And you can't really call it a closing cost because it's a proration, but what happens is you have a property owner that has prepaid association dues. And those prepaid association dues, let's say, they're either paid for the whole year or paid for a quarter. So it depends when you close. But what happens is the buyer now needs to give a credit to the seller because the seller paid for the whole year but didn't live in the property the whole year, or paid for the whole quarter but sold midway through the quarter but prepaid for it. So the buyer has to give a credit for what they call seller prepaid. Does that make sense? I'm sure everybody's nodding and enjoying your coffee. As we are, I want to move on down here into really the nuts and bolts, because typically what you have on a closing cost, and we'll go on both sides here, is you have a real estate commission. and real estate commission can be negotiated with your agent, but you should always be aware that that's on there, and you would know about that. Real estate commission is a seller's expense. Now, the buyer may have, with their agent, they may have a broker transaction fee of all different ranges, and that's something you would ask your real estate agent and say, hey, what's the broker transaction fee? And you're prepared for it. If you were moving on down, one of the big questions we typically get if you were a seller is, what is documentary stamp tax on the deed? And it's a great question. And what happens here is this. Obviously, in the state of Florida, there is no income tax. So one of the things the state of Florida does in order to generate revenue is they tax every real estate transaction. And what the Florida Department of Revenue requires is that for every deed, there's a documentary stamp tax, and they're going to charge that seller, because it's typically a seller's expense in the real estate contract, $7 per thousand. So if you take the purchase price and you multiply it by 0.007 or 0.007, you will figure out what your documentary stamp closing cost is. And here's the thing, that is not a negotiable fee. The county won't even record that executed deed at closing unless that portion is there. And what the county does is they take that money and they send it right to the Florida Department of Revenue. And that is what they call the documentary stamp tax on a deed. Okay? And that typically is a seller's expense. I've kind of dived into a couple of the closing costs. I want to be able to, as we wrap up towards the end of the show, I'll go into some further ones here. Coming up here after the break here, we're going to be able to sit down with number one. We'll start with Mr. Justin Cottrell, who's a real estate attorney here in Naples, Florida. And I want to be able to hit him some of the questions that you guys have been asking about real estate law and the best way to get into a contract, or what is the finance contingency or the inspection period, and all those things we'll be able to address with Justin Cottrell coming up right after the break. Stay tuned.
Are you getting ready to buy or sell real estate and have questions about the process? Or do you just simply want to know what the costs are going to be? Join us here Saturday mornings at 7:30 as Cottrell Title and Escrow presents The Closing Experience, real estate talk over a cup of coffee, a weekly show dedicated to talking Southwest Florida real estate. Can't wait until Saturday? Call Cottrell Title and Escrow now at 239-431-8200 or visit fltitlegroup.com.
Welcome back to The Closing Experience, real estate talk over a cup of coffee. I'm your host, James Schlimmer with Cottrell Title and Escrow. As I mentioned many times before, I love the fact I can reach out in the hallway, grab whether it's BJ Cottrell with Cottrell Tax and Accounting or Justin Cottrell, real estate attorney here in Naples, Florida. But I'd like to welcome Justin Cottrell to the show. Say, hey, Justin.
Thanks for having me. I appreciate it.
It's great to be here on a Saturday morning, enjoying all these wonderful cups of coffee that you don't like to drink, which I still think is interesting.
We're going to go over that again.
Yeah. Let's dive right into it, though.
Yeah.
Because we've gotten a lot of questions at The Closing Experience at fltitlegroup.com, and folks are calling 239-431-8200, and they have legal questions. And inevitably what comes up is, hey, when is the best time to talk to an attorney? And I know one of your pet peeves are when people come in and they're already under contract and they got their deposit, and they'll say, well, hey, Justin, everything's okay, right?
Yeah, that unfortunately that happens a lot. We what is unfortunate about it is that people are signing a legal agreement, the real estate contract presumably, which sets out certain rights and obligations, and then come to me and ask me whether or not what they already agreed to is all right or in their best interest. The problem with it is that whether or not it is in their best interest it doesn't matter. It's already, for the most part, too late because you've already signed that agreement. If you did have questions, or if you did want to discuss how to most optimally set up this contract to protect your interests, the time to do that is before you sign the document, and put yourself in a position where you're subject to these duties and obligations.
In the first segment of the show, I went over kind of the closing costs. And typically one of the questions will come up at closing is, well, hey, why do I have to pay, doc stamps on a deed? Or why am I paying for title insurance?
Sure.
Right? And inevitably it comes down to what's in the contract, right?
Yeah, you're paying for it because you contractually agreed to pay for any one of those costs.
So it's a simple tip, but you want to ask all the questions before you sign, right?
Sure. Sure. And with that being said, though, in the state of Florida, in Collier County specifically, there's two general types of contracts that everybody uses. One is the FAR-BAR standard form. The other one is what we call the NABOR standard form. The FAR-BAR is the Florida Association of Realtors and Florida Bar Association. They collaborate on the contract, which presumably treats both sides relatively fairly. Now, there are some certain things in that contract that you can, for the most part, they're check marks on who's going to do what. So that would differentiate itself. But let me just digress a bit. The NABOR contract, again, is part of the Naples Area Board of Realtors, creates this contract, again, with the presumption that they're trying to create a document in which both the buyer and seller are treated fairly. So if you have questions about these documents, or if you want to be treated in a different way than what the default is, that's especially the time that you'd want to give an attorney a call or talk to your attorney prior to entering that contract. But if it's just the run-of-the-mill deal and you don't really have anything specific, you can feel fairly certain that the contract will be fair on both sides by entering one of those standard contracts. Another caveat to that is there's an addendum to the contract, both the contracts, that essentially gives you a 3-day right to have the attorney review that. So I understand in the closing process you have a willing buyer, willing seller. A lot of times people don't want to throw an attorney in the mix at that point when you've already struck a deal. In those cases, I would suggest go ahead and executing the contract with the addendum to that contract that gives you the right to review with your attorney within the next 3 days.
So some of the questions that have come in, and a lot of them, I'm just going to sum it up into one, because the most common was, well, hey, how do I know I can get my deposit back? I'm getting a mortgage, and if I don't get the loan, do I get my deposit back? And when you're on our side of the business, like, what a loaded question that really
Sure,
is.
yeah.
Can you or can you not? But you will also get a lot of questions where you have these for sale by owners, and they don't want to use a real estate agent.
Yep.
But they're using either a Naples Area Board of Realtors contract or the FAR-BAR, which is the general state of Florida contract, but they don't understand the differences. I was wondering if you were just to say, hey, you're in Collier County and you're using the Naples Area Board of Realtors, just the little pitfalls of, hey, that finance contingency, what could happen, what could go wrong? Because most people think, well, I don't have to do anything, I'm going to get the loan.
Sure. And the finance contingency clause of both those contracts are certainly the most debated, maybe, and disputed issues that could arise. And when we talk about finance contingency, what we're essentially saying is that you're agreeing to buy a piece of property, or you're agreeing to sell a piece of property to somebody else, but that deal is contingent upon the purchaser obtaining financing for that deal. And in the event that they're not able to obtain financing, presumably they should be able to terminate the contract and receive their entire deposit back.
Sure.
Now, the nuances in each of those specific contracts are what can get tricky. For example, in the Naples Area Board of Realtors contract, the finance contingency date is a default date if it's not put in there, but typically it is 45 days after the
Effective date
date of the contract. And what it then says is that in the event that the buyer does not waive that finance contingency after the finance contingency deadline, either party can terminate the contract. So, let me just give you an example.
What an
here.
interesting pitfall.
Sure,
there.
yeah. So let me give you an example here. I go to buy my dream property. My wife, my kids were all so excited about this. We go and we get under contract, and we're closing in 50 days from the effective date of the contract. After 45 days, we do not waive that finance contingency because we're buying a $500,000 place and we put 20% down. So we have $100,000 at risk here. So we decide not to waive that finance contingency.
And your lender's telling you, hey, you're going to get the loan. Everything's great.
Lender's telling us the whole time everything's great. Now, the day before closing comes, the seller gets a better offer and sends me a notice of termination. Now, the property I thought I was going to move into that following day, I'm all of a sudden not moving into. The seller has now terminated the contract, taken a better offer, and I'm out of luck. So those are the things.
In that case, would that buyer get his deposit back, though?
Sure. The buyer does get his deposit back, but that's that doesn't mean much when someone's planning on moving into their new house 2 days from now.
That sick feeling that you have.
Sure. So that's something that you just have to be really careful about. And specifically to your point, James, is that the nuances in that finance contingency clause are so different between the Naples Area Board of Realtors contract and the Florida Realtors in Florida Bar contract, the FAR Bar contract, what we call them. So you really need to pay particular attention on what contract you're using and then the specific nuances of that to ensure two things. One, that you will be able to buy the property. And then second, in the event that the lender is not able to, or that you're not able to obtain financing from the lender, that you can get your deposit back at the end of the day.
So we talk a lot on the Closing Experience Real Estate Talk over a cup of coffee. And I just want to bring up, I'm sitting here with Founding Attorney of Cottrell, Title and Escrow, Justin Cottrell. And we're talking about kind of the legal questions that folks are sending into the Closing Experience at fltitlegroup.com, or they're dialing in at 239-431-8200. And feel free to do that, folks. We'll make sure that Justin answers your questions when we can grab them in the hall and sit down and do this. I've discussed a lot about using a fantastic real estate agent and the difference between a fantastic real estate agent and then there's rookie green real estate agents that don't understand the contract, right?
Yeah.
But there is
especially in this town specifically. There's a lot of people who've moved down here, 3 or 4 years ago and said, hey, you know what? I'm going to be a real estate agent. And they go and they take the 40-hour class, they pass the test, and they don't know what in the world they're doing. They're hoping they're going to get 1 or 2 deals a year, make a lot of money. It's going to be the easy life. And that is a dangerous, dangerous proposition to get into.
I mean, we have seen on countless occasions just the wrong box being checked on a contract and a buyer's deposit being in jeopardy.
Sure.
What's your recommendation to real estate agents who are listening to this show? Because they're allowed to prepare the contract, but they're not allowed to interpret it. So when that client to them says, I'll get my money back, right? Sure. What do they do? So
you're raising a good point. That's a tough position, even for the most experienced real estate agent to be in, because the buyer in this situation is really depending on this agent's expertise, yet they are not an attorney. They should not be interpreting legal documents. So what do I suggest to agents? I suggest you have a very good relationship with a real estate attorney in town, that you can pick up the phone and you can get them on the line and talk to your buyers or answer the questions that you might have. And if you don't, as I'm sure James will point out, we are absolutely open for business. But with that being said, there are a number of very good real estate attorneys in this town. And the most important thing that an agent can do is have a good relationship with them. And I couldn't stress that anymore, is that you need to be able to pick up the phone. You need to have somebody's cell phone number. You need to be able to get a hold of somebody on the weekends. That's your livelihood, and you need to be able to get a hold of them. So that's what I'd stress. That's for any agent.
I know we're running out of time here, Justin, and I love the fact of being able to sit down with you and discuss all things real estate. Again, the number of questions that we're getting that are legal related are through the roof. And when you grab and try to have a conversation about the finance contingency, we can go and we have talked for hours about the small intricacies.
Yeah.
But the point here is that if you are a seller in Lee County and you're getting ready to sell, or a buyer in Collier, if you have questions, feel free to pick up the phone. You can dial 239-431-8200. And what we'll do is we'll make sure that we can answer those title-related questions for you. And if you have questions on, hey, what are my closing costs? We're happy to help you out there. And as always, I will do my best to get Justin on the show, and we can kind of go over in general detail some of these questions.
Yeah, and the more specific ones, as you know, we're available. We're always available to be able to answer any questions that you might have. And, we're happy to help out here.
Let me just real quick, because the other one is, hey, inspection period. And as we're wrapping up within a minute here, it's brutal, but are there some cases where on certain contracts where the seller, just by being under contract, has already agreed to give forth a certain amount of money?
Sure. For what we call defective inspection items, specifically with the FAR Bar contract that they have already agreed. If everything's left blank, it's 1.5%. And actually, the FAR Bar contract refers to it as general repair items, which is a very specific thing. It's a term of art that sometimes it's difficult to tell what is a general repair item and what's not.
Again, if you have questions, feel free to reach out to Cottrell Title and Escrow. We'll make sure that we can do our best to get Justin on the phone or one of our attorneys that we have on staff, 239-431-8200, or head over to fltitlegroup.com. We'll be back right after the break.
Grab your favorite mug and fill it up with your favorite blend because we're getting ready to sit down and talk about Southwest Florida real estate. Cottrell Title and Escrow presents The Closing Experience, real estate talk over a cup of coffee. What are my closing fees going to be? Should I rent or should I finally purchase? Why do I have to send all of these documents to get a mortgage? The real estate process doesn't have to be frustrating. Let our experts at Cottrell Title and Escrow help make buying or selling real estate a dream. Here to answer all of your questions, our host, managing partner of Cottrell Title and Escrow, James Schlimmer.
Welcome back to The Closing Experience, real estate talk over a cup of coffee. I was able to grab, and I said we were going to be able to get him on here, but I'm sitting down with BJ Cottrell from Cottrell Tax and Accounting. And one of the things, BJ, I know I wanted to discuss because we're getting questions to The Closing Experience at fltitlegroup.com. Folks are dialing 239-431-8200. But we got new tax law changes. And what do those new tax law changes mean in the world of real estate? So I wanted to be able to get you on here, The Closing Experience, and be able to just flat out ask some questions and say, hey, what are these changes? Specifically, what's coming in is, hey, am I still able to write off my mortgage interest as a deduction?
Sure. So obviously there was a whole bunch of tax law changes, right? And a lot of it was around businesses and things along those nature. And this is probably the biggest tax reform we've seen probably in our lifetime because they did so radically change all the tax laws. But, not getting into all the specifics of it, obviously this is a real estate show. We want to talk more about things that were specific to real estate and mortgage interest to start with. So let's talk about the mortgage interest. So to kind of talk about the changes, we got to kind of define what the tax law was for 2017 so everyone kind of understands. So in 2017, we were able to take mortgage interest deduction on your Schedule A, your itemized deductions. You were able to take it up to $1 million of acquisition debt. Okay. Then on top of that, there was a special law that gave us the ability to write off a line of credit or home line of credit of up to $100,000.
Sure. Okay.
Now, the cool thing about that $100,000 special law was the fact that it gave us the ability to use that for whatever we wanted to. So that $100,000, right, you could buy a boat, or you could go on a really crazy long vacation. You could do anything you wanted to with that money, and as long as it was secured on your primary residence, you were able to write off that interest as well.
Yep.
So what happened is they came in and they made changes to the law, and one of the changes was mortgage interest. And what they changed was now, instead of being able to take up to $1 million or $1 million of acquisition debt, the interest on that $1 million, we can now only do the interest on up to $750,000. So that is $750,000 on your personal residence and your vacation homes or second homes. You're able to write up to a total of $750,000. You can write off the interest up to that. What they also did is they got rid of that special $100,000 line of credit or home equity line. And what's happened is people have gotten very confused by this.
Sure. This is where, hey, are you allowed to write it off? And then it has to be used for the house. But how do you define what's used for the house?
So what got really complicated is the way people put out these changes was there's no more home equity line deduction. And that's not true. You still can write off interest on your home equity lines. But the old law of being able to write it off for $100,000 for buying anything is gone.
Yep.
So let's take this example. Let's say I have a $400,000 mortgage on my house. Okay. I can obviously write off the interest on that $400,000. And if I get a line of credit to substantially improve my home, okay, it has to be acquisition debt or improvements to that home, let's say I was building on a pool. Let's say I was putting on a second story or an addition, and I pull out a line of credit of $150,000 even. Because of it's $400 plus the $150 is $650. I'm under the $750,000. I can write off the mortgage interest on both the actual normal mortgage, but also the home equity line. I can write off that interest as well.
We're sitting here on the Closing Experience Real Estate Talk over a cup of coffee. I'm able to sit down with BJ Cottrell of Cottrell Tax and Accounting, and the questions that we're getting are, hey, we understand there's new tax laws that are coming. What are the implications in the real estate market? We've got real estate agents calling us. We've got buyers and sellers that want to understand what's happening. And BJ just kind of went over, hey, you could still write off your mortgage interest, except it's up to $750,000. Correct.
Well, down to 750.
Down to 750,000 from $1 million in 2017,
Correct.
And you can still write off home equity line of credit mortgage interest, just as long as you're using that money towards improvements on the home.
Correct, exactly. And then there was one other big change for real estate. Okay, so the first thing was lowering the mortgage and getting rid of the special $100,000 extra home equity line. The second one is property taxes. So in the past, we've been able to write off, again, on Schedule A, itemized deductions, we're able to write off property taxes for both our personal, our second home, our third home, our fourth home, even investment lots and things of that nature. We've been able to write off property taxes. Now, these property taxes are also included, they like to call them SALT, okay? And it's state and local taxes. So here in Florida, we don't have income tax, right?
Correct.
So we're able to take a formula that gives us sales tax, or what they believe based on our income, sales tax would be around about. And so we take that sales tax number plus all of our property taxes, and that equals the total taxes we're able to write off on our Schedule A or our itemized deductions. People that live in New York, though, they pay a lot of money in state taxes, and they were able to write that off as one of the deductions on their tax return with these other state and local taxes. What the IRS did is they limited these taxes to $10,000. Okay. This is a big deal.
Sure.
So, so there is now a limit of $10,000 that you can write off for property taxes, but it's the total or the cumulative of all the state, local, and property taxes. So, and it's for your first house, your second house, and any of these other type of properties that you would have that you've been written off in the past. So, let's take one of our, people from New York. Okay, that vacation down here, or they spend 2-3 months out of the year down here. They probably had state and local taxes up there of, who knows, $5,000-$10,000 just in income taxes. But then they also have their property up there that they paid property taxes of $8,000 a year for, maybe more.
Maybe more, some $30,000.
Yeah, sure, because it's New York, right?
Sure.
So, and then down here they had a house that they were paying $7,000 in taxes on as well. Now all that money that they had, let's say it was $25,000-$30,000 that they were writing off for the taxes, has now been limited to $10,000. So for the average person that only owns one home, and here in Florida where we don't have income tax, they're probably not going to go over this $10,000 limit. But people that have multiple homes, people that live up north where they have state income taxes, they're going to feel this, and you've seen, especially on the news and in different places, people being very upset about this change, because of the fact that the states that have income tax are really going to lose out on this.
So what do you suggest for folks that are either they're getting ready to prepare their taxes or they just filed their taxes and they're wondering, hey, did we leave money on the table? Or, because the other thing too down here is Hurricane Irma and some of the tax write-offs for that, correct?
Sure. So this was a change. Most of the changes we're talking about are changes that are for 2018 in the future.
Yep.
But one of the changes they did do is they put in some safe harbors and some easier ways to write off losses, casualty losses on your tax return. And those retroactive back to 2017 because we had, here in the United States, we had about 3 different hurricanes that hit. We had California fires. There's a whole bunch of different things that happened. And so there's some real safe harbors. There's some things that we can do to write off those losses. One of which is if it's under $5,000, all you need to do is give a good faith estimate.
Let me ask you this quick. So is it every time there's a natural disaster? So if whether, Hurricane Katrina, let's just say, and the folks in New Orleans, there were the same tax write-offs for them? Is that just a standard thing, or is that special for Hurricane Irma?
So what happened was back then they actually created a law that was just in effect for that. What they've done now is they've put in a more permanent law that can happen. So any presidential declared disaster now will fall under these new safe harbors, or these new ways of being able to write off losses.
And the president has to declare it, not
Correct.
a governor state of emergency type thing.
Nope, it's got to be the president. And they're pretty loose with these type of things. I mean, for example, for Irma, I believe the whole state of Florida was declared a disaster. So you can probably utilize it a lot more than most people think. But it's really good, because what happened is that it was too tedious for the IRS to determine what the loss was, and it was very hard for the individual to say what was my loss and how do I prove what my loss was. There was not a lot of guidance. So having these safe harbors, having these things, back to what I was saying before, the easiest one is under $5,000. If you had less than $5,000 in damages, all you have to do is give a good faith estimate. That means you're literally just writing down on a piece of paper that my pool cage got damaged, and therefore I lost this, or my house had a tree fall on one corner of it, and I think it was worth $4,000 worth of damage. So we can do things like that, and that you can write that off. The second one is that you can actually get quotes. If you're under $20,000, you can get quotes from GCs. You have to get 2 of them. And if you get 2 of them and you take the lower of them, you can use that. And the really cool thing is you don't even have to fix the damage, right? This is not actually having to fix the damage. This is a loss in value on your home. And so you're able to write that off as a loss. Another really good one that we're seeing a lot of people use is insurance. If you actually got an insurance claim, right? So the total damage on the insurance shows that it was $20,000, right?
Sure.
But you have a $10,000 deductible, and they only wrote you a check for $10,000. We can write off that other $10,000 as a loss and use that insurance document as our proof of what the loss was.
Where do you suggest folks go because the Hurricane Irma thing is timely here in Southwest Florida, and that's the questions that are coming in. Where can folks go if they want to find out more information about what they can write off on their 2017 taxes based on Hurricane Irma?
Sure. So we've created a website, actually, www.irmarefund.com. And on that website, we basically go through all of these different, kind of safe harbors, or all the different rules or avenues you can go down in trying to figure out what your loss is. And so we've laid those all out there. We've given some explanations about it. And so that's probably, I'd say, the first start. We try to put it in as much of, layman's terms as possible so that people can kind of read through it a little bit easier than the IRS code. But that's probably the first good start. And as I think about that, there's also a page on there. We've been talking about individuals, but there's a page on there for business owners as well. Because the IRS is giving a really large discount or a really large credit to business owners that actually paid their employees while they were shut down or while they were partially shut down. And so there's a link there to the business aspect of those deductions as well.
That's perfect. BJ, thank you so much for sitting down with us. We're here on the closing experience, real estate talk over a cup of coffee with BJ Cottrell of Cottrell Tax and Accounting, talking about, all the new tax law changes, what you can write off, Hurricane Irma. Coming up after the break here, we're going to be able to dive right back into some more explanation of the closing costs, and we'll take it from there. Stay tuned.
Are you getting ready to buy or sell real estate and have questions about the process? Or do you just simply want to know what the costs are going to be? Join us here Saturday mornings at 7:30 as Cottrell Title and Escrow presents The Closing Experience, real estate talk over a cup of coffee, a weekly show dedicated to talking Southwest Florida real estate. Can't wait until Saturday? Call Cottrell Title and Escrow now at 239-431-8200 or visit fltitlegroup.com.
Welcome back to the Closing Experience Real Estate Talk over a cup of coffee. I'm your host, James Schlimmer with Cottrell Title and Escrow, and we are sitting here talking all things real estate. I love our firm, our company, Cottrell Title and Escrow. I can open my door. I can grab a Justin Cottrell, a real estate attorney who's got 10 years experience here in Southwest Florida. I can grab BJ Cottrell, a tax expert, and specifically taxes relating to real estate transactions. And I can get them in my office and we can sit down. So this has just been a great show. I'm happy about it. At the start of the show, I was discussing closing costs on a real estate transaction, and I ended with documentary stamp tax on the deed. And what I wanted to share is that if you are a buyer and you're getting a mortgage, the Florida Department of Revenue is going to tax you as well. There's documentary stamp tax on a mortgage, as well as what they call intangible tax. These are non-negotiable fees. And it's just, think about it this way. There's no income tax in Florida. So Florida is going to figure out a way to drive revenue, and they're going to tax every real estate transaction. If you're getting a mortgage, they're going to tax you $3.50 per thousand on the loan amount. So how do you do that math? Take whatever amount you're borrowing. So if you're borrowing $250,000, you take $250,000 and you multiply that by 0.0035. That will give you the documentary stamp tax on a mortgage. Then what you do is the intangible tax, which also goes to the Florida Department of Revenue, is $2 per thousand of that loan amount. So you take that same loan amount and you multiply that by 0.002, and you have your intangible tax. You take your intangible tax and you take the doc stamps on the mortgage, add them together, and that will give you a great idea of essentially the documentary stamp tax on the mortgage. Most folks, when they're thinking about closing costs, they forget those, and they could be significant because it's based on the loan amount. They are non-negotiable. And what happens is the county, just like with the deed, they will not even record that executed mortgage unless those funds are there. So the county takes them and sends them right up to the Florida Department of Revenue. Some other closing costs. Estoppels. And what is an estoppel? And if you are, it's typically a seller's expense, but if you are a seller and you live in an association, any association, that title company has to make sure that you don't have any outstanding dues. Because those dues can create a lien on the property. So what happens is that title company has to reach out to your association, and that association is going to create a piece of paper that's essentially going to say, hey, what your dues are, when are they paid, and are you guys behind? Are there any special assessments that are due? Or it gives these details, but the property management company for the association or whoever's in your association typically charges a fee for the creation of that document. And that fee could be anywhere from $250, or if it's a rush closing, it could be $350. But sometimes it's $100. It could be anything, but there is it won't exceed $350, and they can only do $350 in a rush situation. But for the most part, we're seeing it's about $250 for that, and that's a seller's expense. And we'll get the question a lot, hey, well, how come I have to pay that? One, it's in the contract. Two, but in order for you to transfer clear marketable title to the buyer, we need clearly to make sure that you don't have any outstanding dues. And if you live in a community where there's multiple associations, which is your Vineyards or your Pelican Bay or your the Colony, let's say, in Estero, there could be multiple estoppel fees. And I'm sure that makes sense because there's multiple associations. Everybody has to check to see what the dues are, have they been paid, and make sure that it's all clear at the time of closing, so the buyer doesn't inherit, that mess. When we continue here and you kind of flip over the cap to buyers getting a mortgage, what are some of the standard lender fees associated with getting that mortgage? This is where a lot of folks are surprised. And it's not so much the lender's charging. The lender has to charge certain things. The lender is going to charge an origination fee or an underwriting fee or a processing fee. And typically it's any one of those or a combination. But that's, hey, the cost for the lender to give you this mortgage and the work that goes into working with your loan officer and all the above. Those are fees that you can shop around for. And each lender is going to have different fees. When you get into a lender is going to require a full year, and this one is always forgotten about, by the way. A lender is going to require a full year of your homeowner's insurance to be paid for at closing. If you were buying cash, hey, it's kind of on you. If you don't have insurance, that's your fault. But the lender is going to require you to have homeowner's insurance, and they're going to require that first year is paid for at closing. So depending upon the size of the property, that could be a $1,200 to a $3,500 expense at closing to have that hazard insurance paid. Now, A lot of first-time home buyers or folks, they love to be able to have their taxes, insurance, all wrapped into the mortgage payment. They want to escrow it at the lender, which is fine. But you need to be aware that when you come to closing, that bank is going to want to ensure that they have enough of a cushion in that escrow account when the tax bill comes come November. So what do? At closing, they're going to collect about 3 months, could be 6 months, of a little cushion for your taxes. So what they do is they take the annual tax bill, divide it by 12, multiply that by 3 or 6 or whatever the lender requires, and they're going to collect that at closing. And then they're going to take your insurance, divide that by 12, whatever the annual premium is, divide by 12 and multiply that by 3 or 6 or whatever their requirement is. And they're going to want to pop that into the escrow as a cushion so they can guarantee that there's enough money in there when they need to disperse the following year. Everybody forgets that. So when you're thinking about how much money do I need to save to be able to buy this house, if you plan on escrowing, and sometimes you don't have a choice, the loan program that you're going to go into, they're going to require you to escrow your taxes and insurance, which is going to require you to have a little cushion. And again, that's money at the closing table that you're gonna have to come up with. So again, when it comes to these closing costs, everybody has questions. And feel free, please, to reach out to the Closing Experience at fltitlegroup.com, where you can dial 239-431-8200. Our team here at Cottrell Title and Escrow would be happy to sit with you and make sure you understand every closing cost, what it is, why you have to pay it, is it negotiable, is it not negotiable, and make sure that everybody feels comfortable in the transaction. That's what we want to do. Some other closing fees. We charge, in our company, we will do what they call a municipality lien search. And on top of that, there's a title search as well. And the title search is our underwriter and us. That's researching the property. And that fee is typically anywhere I've seen them from $75 up to $200, let's say. And what you're paying is you're paying for folks to research from the conception of the property, the history, all the way through. And what they're doing is they're creating a title commitment off that search. And that title commitment is essentially, hey, we will commit to give you title insurance as long as you clear all these issues that we were able to find in title search. A municipality lien search, which is something that we will do, looks for all items that aren't on public record, because a title search is only looking for items that are on public record. So when you think about, all right, wait a minute, if the title search covers me for all the liens and judgments and mortgages and everything that would show up in public record, well, what about items that aren't on public record, like outstanding water bill or outstanding building permits or special assessments from the county, code enforcement violations? All of those things don't necessarily show up in public record. You can have a code enforcement violation on a property and not have it be a lien yet, so it would never show up on a title search. So what we do at Cottrell Title and Escrow, and it's a $75 charges, but we'll go to those entities, the code enforcement, we'll go to the building growth management department, and we will search to make sure there's no outstanding building permits, or if they are, we make sure that you're aware of it, so you're not getting stuck with that information, or you don't inherit a problem. And that's something that you'll typically see where that'll be about a $75 charge. There's the cost for title insurance. Your title insurance policy is a significant charge that you need to be aware of, because essentially that's insuring your purchase price. Or if you're getting a loan, it's insuring your purchase price, and your lender is going to require a lender's policy as well. So that's all the work that goes into, one, making sure that your money is protected against any claims or liens or anything that may come up if there was a problem where, did the seller really have the right to be able to sell you that property? Were they who they said they were? If it was a corporation that sold you, did the person that signed the deed actually have the authority at the corporation to be able to transfer that property to you? If it was an LLC, same situation. If it was a trust that was selling it, does that trustee really have the right to be able to transfer that property? There are a number of scenarios on why one would need title insurance. But the cost for that policy, which is a one-time charge that you'll have for the life that you own that property, protects your investment into this property. And on a lender standpoint, it's going to protect the lender for their loan amount. So that's just a basic idea of some of the closing costs. Again, if you have any questions, please feel free to reach out to The Closing Experience at fltitlegroup.com. If you go to fltitlegroup.com, we have a closing cost tab on there, which you can register and go in there and be able to work every possible calculation you could ever think up and really get a true understanding of your closing costs. Again, you may have questions on that and say, why do I have to pay this? Or is this negotiable? Or can we work on that? Again, you call 239-431-8200, and we will do our best to make sure we can explain those fees for you, make sure you understand them so you can plan accordingly, which is what we're looking for. I love being with you guys each and every week here on The Closing Experience, Real Estate Talk over a cup of coffee. We had a great show today sitting down with real estate attorney Justin Cottrell and BJ Cottrell from Cottrell Tax and Accounting. Our goal here is to make sure that Southwest Florida residents are comfortable when it comes to a real estate transaction, and we hope that you will look us up if you're getting ready to sell a property in Lee County or purchase a property in Collier County. You can choose to close with Cottrell. Just let your real estate agent know that you like to close with Cottrell. And they know how to get a hold of us. But you can dial 239-431-8200, or you can head over to fltitlegroup.com. I hope you decide to choose to close with Cottrell, and I look forward to speaking with you next week. Thanks so much.